Hello everyone, it's Irfanali Moladina with RMI Professional Corporation doing our quarterly one-on-one question and answer. So looking forward, we have some people joining. I see I'm going to give it a couple more minutes and let everybody hop on. But for those who are part of our newsletter, you would have seen that this quarter we're focusing on a topic about investments, and when we sent this out to our clients, we had lots and lots of questions come back. So I think today will be a pretty good chat. And of course, as you pop in, any questions you have, feel free to post them down below, and we'll go through them here over the next little bit. Once again, it's Irfanali Moladina with RMI Professional Corporation, and we're going to be doing our one-on-one quarterly session here, and it's going to be talking about investments. But even if you have questions that are outside of investments, we can for sure answer anything. It's open to everybody. And for those that are in Calgary like us, I hope you're enjoying. Winter has finally arrived. We have a ton of snow outside, so I'm hiding in the office, and we'll be hiding here for a little while, that's for sure. Perfect. We'll give it one more minute here, and then I'll get started with some of the questions that came in online already. As I had mentioned, we had sent out our quarterly newsletter, so if you're receiving that, then that's wonderful, and if you're not, feel free to make sure you sign up for it as well. And we provide quarterly tips in there as well, and we always attach that to our quarterly one-on-one session here. And so with that, I'm going to get started with some of the questions that came in online in advance. And the first one actually is a great one just to get things started. So one of our clients asked here that they're determining how to calculate capital gains when there's a primary residence with additional properties on the land. So they have a parcel of land that is about 0.87 of an acre, and initially they had just the land. Cabin was unlivable. A couple of years later, they've fixed it up, they've made it their principal residence, added a couple more properties, and now they're kind of wondering, how do we go about calculating capital gains? And so on that side, it's a tricky one for sure, and I'll mention a few things. Of course, in this situation, you probably got to go down to a bit more in detail, but from an overall perspective, the things to keep in mind is you can actually have up to 1.2 acres of land attached to your primary residence and treat that all as a primary principal residence. If you have more than 1.2 acres, then you have to factor in the cost of the land and actually calculate a capital gain on the land separately from your principal residence. In this situation, the question that was asked is there is multiple properties on a 0.87 acre land. And in this situation, what would happen is we'd have to determine the portion that is principal residence related and the additional units that are there for the cabin. We'd have to figure out what the cost base is of those. And when the units are sold, of course, then we determine what the actual capital gain is on those cabins that are rented out. So it does take a little bit of legwork for sure. Something we're happy to help with if needed. So just reach out and we can help do those calculations in more detail. And so here's another question that is here. Should I invest in stocks from my business account or personal account? What are tax implications for each? So this is a great question, and it ultimately depends on how your business is structured. So those of you that are clients of mine that I've been dealing with for a while, you'll know one of my favorite things is the holdco-opco setup of a business. So if you're running a business, we've talked about it in the past, but you'll have a holding company that owns your operating company. And in this scenario, what I like to do a lot of times is maximize how much you can keep inside your corporation, minimize your personal taxes, and then you can take that money and invest it through the business. Now, when you're looking at stocks, it really depends what type of stocks. Is there going to be what type of income you're earning, dividend income versus capital gains? If it's capital gains related, you're buying some stocks, you're holding it long term, this is a great strategy because it gives you more after-tax money that you can sit and hold until the time that you actually go and sell those stocks. Now, what else is really interesting in this topic, it is not a one case fits all by any means. And the reason for that is on the personal side, there are some interesting tools available. RSPs, TFSAs, everyone's probably heard about them. So a lot of times what I try to do is say, let's look at it from a holistic standpoint. Let's see how much money we want to pull out. Let's see if we can invest some on the TFSA potentially, depending on what tax bracket you're falling in. Potentially some RSPs. I'm not as big of a fan on maximizing RSPs all the time. I think there needs to be a balance for sure there. And then the second component of that is the rest we can leave inside of the corporation. So there are a few different strategies that are available, of course, and that's why I'd say it's not a one case fits all by any means. It's something that we look at on a case by case basis. Is there a term called safe investment? What are some of the safe investments? So there is something called safe income, and that is your profits. Essentially, it's your profits that are retained in the business that you're allowed to give out as a dividend. In terms of safe investments, there is a type of investment that you can do that's called a safe. It is typically when you're doing an equity play. And what it is there's an equity play when you're doing private enterprise or when you're investing into a private company. They get very specific in there, so we can always review those together, but that depends on what you're looking for exactly in terms of that safe investment. We can go into that in more detail. Do I get taxed differently on income that I make on my investments? So that's another good question. Now, if it's on the personal side, the answer is typically no, unless you're getting dividend income. So dividend income gets taxed at a little bit of a lower rate, and there's two types of dividends. One is eligible dividend, one is non-eligible dividends. And so eligible dividends actually get taxed at a lower rate on your personal side because the company has typically paid higher levels of taxes in your on the eligible dividend, the company has paid more taxes, so when they're giving you the dividend, it ends up actually being a little bit less on the personal side. A non-eligible dividend, the company has typically paid a lower level of tax. So for example, if you're a small business under $500,000 of income, your tax rate's only 11% here in Alberta. And so if you've only paid the 11% rate and you've given out a dividend, then that comes in as a non-eligible dividend, where you end up you still pay your personal tax on it. It's a higher rate than your your eligible dividend, but it's still lower than your actual employment income. Now, finishing with that question, if you are investing through your corporation, passive income inside of a corporation does not get that same benefit of that lower tax rate. And so what happens is your income actually gets taxed at a higher rate, but then when you take a dividend out and you pay the personal taxes, the company gets a refund of the extra tax that they've paid. So inside of a corporation, you do end up paying higher tax on your investment income at the end of the day. And so some more questions coming in here. What is good investment idea to save taxes, TFSA or RSPs? So good question there for sure. I'm a big believer of the TFSA. RSPs I think are a good tool, but you have to use them smart, and you got to see where you are in terms of your tax bracket. And so I know historically a lot of people have always preached RSPs, 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 and you get the initial benefit for sure. There are some good benefits with RSPs. They're protected through bankruptcy. You can do tax-free transfers to spouses on separation. So there are some good benefits, but the one thing I caution people about with RSPs is long-term, when you retire, if you have too much in your RSPs, you're at risk of losing some other benefits. So for example, if you have $1 million in your RSPs and you turn 71, you're now required to take out a portion in terms of the RSP converts to a RIF, where now you get paid on a monthly, quarterly, or annual amount. But that amount that you're taking out will typically push your income into a higher tax bracket. And secondly, it can impact and create clawbacks on your old age security, for example. For those that are lower income and they've only saved up a little bit in RSPs, it can still have an impact, because lower income seniors can qualify for things like your GIS, your guaranteed income supplements, And some of in Alberta, there's Alberta Seniors Benefits. But if you have RSPs, that counts towards your income when you're pulling it out, and you're at risk of losing some of those other benefits. So what I always tell people is depends again on your situation, but you want to have a balanced portfolio, and you really want to see what is your retirement strategy. Some people go out and say, okay, you know what, I want to have some real estate property. I'm going to live off of the cash flow of this. This is how much I anticipate making. Then we can determine how much is a safe amount for you to put into your RSPs. TFSA is a nice option as well. And the reason for that is because it's tax-free in terms of the growth, but more importantly, when you pull that money back out, not only is it tax-free, but it doesn't hit your income. And that's why it's one of my favorite vehicles, especially on the personal side. So anybody that's got extra income on their personal side, for sure, maximize your TFSAs. Because when you take that money back out, it's tax-free. When you're putting money in, it is after-tax money you're putting in, but the growth on that investment all comes back to you tax-free, which is really nice. So some more questions here. Can we spread our capital gains over years? So that's a good question, and it depends again what type of capital gain. So if you're getting capital gains on stocks or investments like that, it becomes tricky. You have to manage your capital gains when you're buying and selling stocks. But one thing that's really nice is, let's say you have a business and you sell the shares on that, or you have a property and you sell the property, but you're carrying a portion of the financing so you don't get all the money up front. In those instances, you can actually defer your capital gains for up to 5 years. Now, by defer, you can't just leave it for 5 years. You have to take 1/5 in every year, starting with the year you sold it. But that is actually a neat strategy that many people aren't aware of, is the fact that you can split your capital gain over a few years. So it does provide an incentive sometimes to carry some of the financing or things like that, because you can end up saving on the other side for taxes. So which investments can reduce taxes? How can I minimize taxes on my investments? So good questions there. Investments to reduce taxes is a tricky one. Of course, you want to use your investments to make you some money, but there are some specific cases where they can save you on taxes. So one is, for example, you can do whole life insurance policies or universal life insurance policies, whereby a portion of the investment is insurance and a portion of the investment is an investment component of it. And what happens with those is the cash surrender value ends up growing over time, and you can actually borrow tax-free off of those. So they can be used very strategically. Again, they're not something that everybody should go out and jump and do. They're designed for certain people. For sure, talk to an advisor before you do that. Make sure it makes sense for you. They tend to be a little pricey, and you want to just make sure that you're putting yourself into a budget that you can actually afford, because you don't want to ever have to jump out of those investments because they could have some penalties attached to it. But those are ones that can help you on taxes for sure. There are some other ones which consist of like flow-through shares or partnerships that carry a little bit of risk with them, but they have high upfront operating costs. And the structures that are typically set up, they could provide you with a little bit of tax savings up front. But those ones, again, are a little bit more risky investments, so you want to make sure you're very careful when going down that water. Another question here, how are we recording investments in books at cost or market value? Very good question there. So a nice accounting one with investments. So investments always get recorded at the lower of cost or fair market value. And I shouldn't say always, because it depends again on the type of investment and if it's available for sale. Is it something that you're actively trading? But just general rule of thumb is it's lower of cost or market. And so what happens is when you see a big capital gain, you typically will not actually pay that capital gain until you sell that investment, which is a big benefit too. Here's a question. If I sell cryptocurrency in the US and Canada, how will I be taxed? And so cryptocurrency is a very neat topic. You should be sure to check out our previous one-on-one chats that we've had. I've gone into cryptocurrency in length and detail. But for this specific question, the one thing we got to note is if we're treating cryptocurrency as an investment, because it could be considered active if you're very actively involved in trading it. But if it's used as an investment, it gets treated as a regular taxable investment. So for example, you might buy some Bitcoin, hold it for a year, sell it, you have a capital gain. That becomes a capital gain at the end of the day, and gets treated, goes onto your personal taxes, or if you have an account through a corporation, it gets put onto your corporate tax as a capital gain. So there's no big difference in terms of that treatment. Where it does change is if you're an active crypto trader, you're doing multiple trades, it's a main source of income for you. You might be involved at that point in terms of staking or doing some of the other elements that you can do with crypto, then it may be considered active income. And if it is active income, then it gets taxed at your regular rates. You don't get the capital gain benefit to it. But inside of a corporation, that could also become a bit of an advantage for you, because now active income inside of a corporation only gets taxed at 11% in Alberta. What is realized or unrealized gain loss on investments? So that's a good question too. So a lot of times when you're looking over financial statements, you might see realized gain, unrealized gain. And the difference is, when you have a realized gain on an investment, it means that the asset has been sold and you've made a profit on it and you've actually received that profit. So I might have bought some stocks in a company. Let's say I bought some Suncor stocks, I sold them, I got my money back out. That's a realized capital gain. An unrealized gain or loss on investment is where that transaction hasn't actually happened yet. So for example, I might have bought my Suncor stocks and I haven't sold them. They might have even gone down in value, in which case I have to record that loss because it's lower of cost or fair market value of the stock. And when I do that, what would happen is I would have an unrealized loss because I haven't actually gone in and sold my shares at that time. So when it comes to tax purposes, you're only taxed on realized gains and losses, not the unrealized gains and losses. But when you're looking at financial statements for a company, we're required to report both realized and unrealized gains and losses. So you may end up seeing both of those show up. Perfect. Once again, just before I continue, it's Irfan Moladina with RMI Professional Corporation. I do this every quarter. We do a one-on-one quarterly session. This one's focused around investments, but don't hesitate. If you've got other questions, happy to answer anything and touch on any topic. So feel free to ask the questions. I know accounting's not always the sexiest topic to talk about, but it's an important topic nevertheless. So I know lots of people have questions, and now's your chance to ask them. So another question here that came in: does market value change affect my tax? And again, this is a very broad question, so high level. If you don't actually sell your investment, then the answer is no, because what would happen is if I have a stock again, I let it sit, it goes up in value, but I don't sell it, then it's not a taxable event to you, so therefore you don't pay taxes on it. Where you might see some change in market value, it could impact your financial statements on an accounting side, but from a tax perspective, it actually won't end up affecting you unless you actually sell that investment. So more questions. We did have lots come in online, so we'll get some of those posted here as well in a minute, and happy to answer any of those. Once again, for those of you who are not familiar, we do a quarterly newsletter, so please make sure you sign up for that off of our website, accountantscalgary.com. And it's Irfan Moladina with RMI Professional Corporation. So just touching on the topic of investments once again, there is always questions that I always get about how to strategize your investment vehicle. And a lot of people say, okay, I'm just going to do stocks, or I'm just going to do real estate. And everybody's kind of heard the term about diversifying your stock portfolio. And I'm gonna move a little bit forward on that, because what I tell a lot of my clients is it's not about diversifying only your stock portfolio, but about diversifying your overall investments. And we're seeing that in today's economy, especially because what's happened in the past is when you have diversified stock portfolios, people are saying, well, one stock goes up, one might be dropping, or one industry might be dropping, but you're covered off because another sector might be growing. And although that's true, what we're seeing in like today's economy, where you have high inflation, interest rates going up, a lot of uncertainty with government and the decisions that are coming down the pipeline, we've seen almost a lot of the stocks end up dropping. So a lot of people today that have had money in the stock market will realize their investments are down 20, 30, 40%. And so one of my strategies is you actually diversify your overall investments too. So yes, you have some stocks for sure, whether that's in the form of RSPs, TFSAs, through a holding company. That's part one. But then you also want to look at maybe some real estate. And then when you have some real estate, there's also other investment options, perhaps some lending, or you can do some second mortgages or lending attached to other assets. And then the other one is you can invest in other private companies. There's also the life insurance I mentioned earlier. So there is a lot of different investment options. So it's really good to get versed with all of them and then decide where you're going to put your investments. And you start small sometimes, but when you start to build up that capital, you want to start diversifying it, because like in today's economy, the stock market's hurting, but we've seen a big jump in real estate prices recently. Now with interest rates going up, that's starting to turn a little bit, and hopefully we'll start to see some additional income because of a stronger economy coming from the stock side again. So having a diversified, not only diversified stock portfolio, but just diversifying your investments as a whole, I think can lead you to a little bit more long-term success in investments. More questions coming in here. Do I still need to claim my U.S. investment as foreign property? So this is a really good question, touches on U.S. and cross-border accounting as well. And what happens in Canada, if you are a resident of Canada, you are taxed on your worldwide income. So what this means is if I have a property in the U.S. or I have an investment in the U.S. that I'm earning income off of, you are taxed on that as a Canadian resident. Now, what will typically happen, depending on the type of investment, you might end up paying some taxes first in the US. And so those taxes you pay in the US, you actually get to claim as a foreign tax credit here in Canada. And that's a really neat trick that a lot of people aren't familiar with. So if you pay investments down there, then what you can do is, if you're paying investments tax in the States, then what you can do is actually receive the credit here in Canada against the taxes you paid. So you never end up getting double taxed. Now what is also important is with foreign property specifically, if you have foreign property outside of Canada over $100,000 Canadian in value, and you're earning income off of these properties or these investments, there is another form that needs to be completed to CRA to identify that you do have foreign property. If you do not complete these forms, the penalties for these are quite high. They can be up to $2,500 per year. So you can imagine you have a property for 10 years, you never file this, it could be a $25,000 penalty plus interest. So it can add up very quickly. And so it's very important, if you do have any foreign ownership of property, any type of investments, make sure you're talking to an accountant who can help you to make sure all your filings are up to date there. I do believe I might have missed some questions, so I'm just going to go back here and make sure that I've answered everyone's questions. Feel free to post them again if I have missed anything. We've touched on, can we spread our capital gains over years? What is good investments between TFSAs or RSPs? Do I get taxed differently on income that I make on my investments? We touched on that. The nice thing for those of you who are joining halfway through, this will be posted after the fact, so you will get a chance to review the whole video, of course. And outside of this, feel free to reach out to the office if you do have any specific questions, and we can make sure we get those answered. Another question that came in here, I'm considering purchasing a rental property. Is it better to operate it as short or long term? Do I have to charge GST on the rent I collect? This is good. I was just thinking that we haven't had a lot of questions on real estate as an investment, so I'm glad to see one come in here. So difference between short and long-term rentals. So for those of you that aren't familiar with that terminology, short is basically anything under a month. Long-term is anything above a month in rental. Biggest thing here is we're talking about Airbnbs, for example, as short-term rentals. So short-term rental actually gets treated as regular active income. And so what's nice about that is if you own a property or you're doing management of short-term rentals, that is all active income, and you get the favorable tax rate under $500,000 at only 11% in Alberta. So there is a huge advantage to that. Now, of course, the reason it's considered active income is because they take a lot more work compared to just having one tenant give you 12 checks and you can put that in the bank. And so they are considered a lot more work, but you do get a favorable tax treatment on it. Is it better? That's a tough question to say. It really depends on the property, where it's located. A lot of different factors come into play. But for sure, we've seen a lot of success with people who are doing short-term rentals in this day and age. Do I have to charge GST on the rent I collect? So long-term rentals, the answer is no. Long-term rentals does not have GST, but short-term rentals do. And so those of you that are familiar with the Airbnb platform, you would have seen over the last little bit here that they've started to ask for GST numbers or things like that, because if you provide them with the GST number and you're doing this through a company that's registered for GST, they will pay you the GST portion that they're collecting on the transaction, and then you're responsible to remit that to CRA. However, if not, then what would happen is you would they'll collect the GST and they'll remit it for you if you don't provide them with the GST number. So it's really important that you do plan that carefully and do it properly so it maximizes your benefit on the GST piece there. And then Sherry's there saying, I emailed asking about 3 cabins on property, 1 primary. I did see that email. I did answer that question right at the beginning, Sherry, so thank you for sending that in. If you get a chance, just visit the beginning of the video once we post it live, and then you'll be able to see. But ultimately, it is something very specific in your case, and so the component of it is when you do have rental and primary property on the same lot, what we would need to do is make sure you're calculating the portion of the property that is rental related and making sure that we're actually taking that component out to calculate what the capital gains is. And then obviously you'd have the primary property, which would be able to claim the exemption on. It is a very similar situation. Because yours is so specific, we can for sure help you out on those calculations, because it does get very tricky and you want to be able to maximize it. So just touching on the principal residence piece a little bit more, what is really neat is on the principal residence component is if you have 2 properties, you can determine which one you want to be a principal residence. And so sometimes it's not always the property you're living in. It might be a vacation home that works out to be better that you can claim it on. And so doing those calculations, it is worth the time to end up going into detail to see exactly which way works out the best. One more last question here, because I think my time is almost done. Like I said, it's a very hot topic about investing, so feel free to reach out. Everyone that knows me and talks to me often, you know I love talking about investments and real estate and stocks, and it's a topic that I always enjoy. So feel free to reach out after the fact as well with more specific questions. But the last one I'll take today, what is tax loss harvesting and how does it work? Basically what that is taking advantage of losses that you might have and sometimes applying it against capital gains. So if you have losses through a corporation, what's really nice is non-capital losses, as they are called. So it's basically operational losses can actually be used against capital gains. And so when you have a capital gain on an investment, you can use some of your non-capital losses to reduce any taxes you might pay on that capital gain. So again, there is some strategies around making sure you're maximizing the losses that you have. there is value when you have a company that has a lot of losses, even though it clearly hasn't been successful, but there is an opportunity to still take advantage of those losses and be able to reduce your taxes somewhere along the line. One more question before we wrap up. Is there a Canadian-based book you would recommend regarding investing and taxes? Oh, that's a tricky one. And the answer is I don't have any off the top of my head. I am a big fan of Robert Kiyosaki, Rich Dad, Poor Dad. I know he talks a lot about real estate and investing from a high level perspective. Will Chilton as well, The Wealthy Barber, is another good one that I've read. That does touch a little bit more on investing and more, not so much on the real estate side, but on the other end. I don't have a good recommendation on one that really talks about good investment strategy specifically, other more from a high level perspective. And the two, my favorite for sure, my all-time favorite book is actually Robert Kiyosaki's Rich Dad, Poor Dad. So if you haven't read that one, for sure read that one. It really talks about the differences of types of income you're earning and how to really focus on like cash flow investing, which I'm a big believer of. So thank you once again. It was Irfan Moladina with RMI Professional Corporation. I'm glad a lot of you were able to join in and some good questions came about. For sure, if you have any other questions, it doesn't stop here. Just feel free to reach out to our office. It can be found at accountscalgary.com. Or just Google RMI Professional Corporation, you'll find us. And if anything else comes up, feel free to reach out. Thank you, everybody.